Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome, everybody. I am Jeff Barton, your voice in the mortgage industry. 888-713-2929. That's the telephone number here. If you want to pick up the phone and give us a call, we talk to you about your mortgage. What's going on with your payments? Do you need to reduce your payments? Is it possible to reduce your payments with rates going up? These are great questions to ask. One of the things that you need to really understand about today's market and today's climate is if you're looking to refinance and you're looking just to lower your rate and term, you either have to switch to an amazing program, either a short-term loan, 5-1 ARM, 7-1 ARM, 10-1 ARM, or go to a 15-year fixed. At both of those, yes, your payments may be higher. However, your rate will be lower. Rate sensitivity is certainly something you have to consider. If you're somebody who's been in their house for 10, 15 years paying off that mortgage, also consider that maybe you should just stay in your home and pay the mortgage you're paying. I know there are many people out there right now who are thinking, can I take money out of my house in order to invest it in some property so I can get some long-term, residual income? The answer is yes, you can, but are you prepared to pay a higher rate? Let's talk rates here for a second. Again, I'm Jeff Barton. This is The Mortgage Voice. You can reach us several different ways. I gave you the phone number. You can reach us by email as well, info@malibufunding.net. We're also on YouTube. We're on Facebook. We're all over the place. The Twitter is @Jeff6493. And, of course, bartonblog.net is my daily or weekly blogs. There's all kinds of things going on about how we communicate and what we do to do that in order to keep you informed. But the main purpose of the show here today is obviously you're driving around in your car. Maybe you're looking at some houses. Maybe you're thinking, man, if I had that extra cash, I could go over there and buy that 2 or 3 or 4 unit building, or at least try to. Yes, I know rates are not as low as they were, but they're not as high as they were either. Rates right now, and let's go over them. This is from Mortgage Rates in the mortgage website that we go to each and every week, Mortgage News Daily. Article by Matthew Graham talking about how in this particular time and place in the summertime, and by the way, happy summer to everybody, 2018. Kids are probably already out of school and you're out there, as I said, shopping around, trying to find something to either buy as an investment, or maybe you're one of these great people who just want to bite the bullet now because you see prices going high. Although I got to tell you, prices are softening. I heard that today on the radio and I almost choked on my cereal. Why did I choke? Because I haven't seen softening in real estate prices in quite a few years. And as we see the rest of the country kind of catch up with what we're doing here in California, we actually saw the aggressiveness of 6.4 to 6.5% per year increase in the value of the properties around San Bernardino, Riverside, Los Angeles, Orange County even more. Certainly, and this radio show is covering most of Southern California as well as some parts of Las Vegas. Las Vegas went up 16.5% last month, year over date. Now, that's insane. But their prices were a lot lower and they crashed a lot harder. But in San Bernardino and Riverside, Southern California, we probably see the dip from 6.4% rise annually to 6.2%. Now, that doesn't seem like a lot, but it's better than going the other way. And in terms of those of you out there looking around, as I said, trying to take money out, do I leave it in? Maybe I'm a millennial and I want to buy that house. It's certainly welcome news when you know that you can afford more than you could last month, simply by the fact that prices haven't gone up. Maybe we've reached that sort of equilibrium where we have equal number of buyers, equal number of sellers, and you get an actual negotiation. How many out there have been in a real estate deal in the last couple of years? There is no negotiation. You just look at a property, and if you want it, you pay what they ask for it, and you also remove contingencies as a way by which you can beat out the competition. I know in Rancho it's really busy. San Bernardino, Riverside counties, come on, it's very difficult to find the perfect house. I understand that. But a house that you can afford, any house, yes, it is difficult. Wages have gone up appreciably during the same time that we've seen housing go up. which helps, right? Obviously, the more money you make, the more money you can afford to borrow. One of the things I also want to talk about right now, before I do that, I talked about rates. Let's talk about rates. 30-year fixed rate, 4.625% to 4.75%. This is a national average. Here in Southern California, you might be able to get a little bit better, especially if you're, close to 760 to 805 FICO score. Yeah, that probably dictates that you get the best rate possible. You want to try to find a lender as well who doesn't have many overlays. Now, what do I mean by overlays? Well, you have a final investor in Fannie Mae or Freddie Mac or Ginnie Mae. These are the big government entities that buy loans, right? They're not really government, but they're owned by the U.S. government, by the taxpayers, really. And each and every month, those particular entities buy tons of mortgages. They buy your FHA mortgage from your lender down on the corner or your massive lender of Wells Fargo. And by the way, Wells Fargo, they're laying off 100 people in their mortgage division, and they're also closing 53 different branches in the Midwest. Now, why is this important? I'll get to that in our next segment. But the FHA VA, their rates are 4.25% to 4.5%, and the 15-year fixed is 4.125%, and the 5-year ARMs, 3.75 to 4.25%. So if you're thinking rate, and you can handle an ARM product that's adjustable rate mortgage, fixed for a certain term, and then it adjusts probably anywhere from a half to a point per year with a cap on it. These are the important things you have to look at when you're looking at ARMs. But if you're going to be in that property and you know you're going to move or you know you're going to sell it, but you don't want to just pay your money in rent and throw it out the window, you want to take advantage of some of that, the way the house prices have gone up, even though they've ticked down a little bit, they are going to continue to rise, 6.5% within that range this year here in my listening area. So if you want to take advantage of that and you can afford the payment, that's where you got to go. You got to go out there, find that property. And by the way, if you can find that property, put in an offer. You probably can get a contingency, i.e. I have to either sell what I got to sell or I have to get approved with a loan. Certainly that's in all the contracts. Your loan contingency is the main contingency in every loan. Yes, you have inspections, but in a market like we have, as I said, you're going to run into the people out there who are selling the property and say, hey, remove contingencies and you'll have a better shot at getting the property. I never want to see somebody not have a home inspection or not have a roof inspection or don't get some sort of geological advice or go down to the city and see if, permits were pulled on that extra room they see in the back. Yeah, these are all the things that you can do within the inspection time period. So if it's my advice, find somebody that you're willing to they'll be willing to have you have an inspection, or your agent says, yeah, you got to keep that in there. That's a good agent, by the way. Anybody that says, I can get you this property, really run from them, because what they're trying to say is, I can't protect you, but I can certainly get you into the property. If an agent says to you, look, I can give you all these options, you're going to make your best choice, but here is my recommendation, that's a good agent too, because they're going to give you the professional advice that they have as part of their fiduciary being best care to you, as if you were they. You are going to give them the best advice out there in the marketplace. So as you see in this particular week, the 4.625 to 4.75, let's face it, most lenders out there, they're in the fives for anybody in the 600 FICO range. Obviously, that is going to affect your rate, and it is definitely showing up in the rates now. And can you believe it? A year ago, we were about 3.75%, so it's really gone up. We're looking for 2 more rate hikes this year, in my opinion. I think the economy is booming. I think real estate prices are up, but as I say, we have seen some inkling that they're going to level off, that what we're going to get is maybe some equilibrium in the market by the fall. Maybe we'll see in certain markets a real loosening of sellers' demands to get the best price possible, which always is the way it is. But in some instances, you'll find sellers, especially in a certain type of market, that'll go, you know what, I need to get this number. I need it sold, and that's what you have to do. You have to go out there and find those kind of properties in this hot market, but they may return in terms of the ability to find those properties in the next couple 6 months. That's the way I think about it anyway. I think rates, what we're going to see steadily throughout the summer, summer is a rising of rates, a continued pricing into the market of what's going to happen, meaning that even though you're not going to see prices hike at the Fed, and by the way, the Fed, as we all know, is the Federal Reserve who hikes or lowers short-term interest rates, and that really affects your credit card and really affects your auto loan. These are the things that it really affects. The mortgages are more hooked into the bonds, but the sentiment in the marketplace is really what's driving the entire... Oh, by the way, I went to the bank today. I bank over at Union Bank, right? Now, there are a lot of big banks. Union Bank was just purchased by, I think it was Citizens, if I'm not correct. But they're joining one of a number of very large institutions. A lot of institutions who are large are laying off mortgage people. Why? Because the loan volume, and we've talked about it many, many times on the show, the loan volume isn't there. So what happens is large lending institutions, Wells, Citi, Citizens, Union, a lot of these do not want to have profit loss, or at least, speaking of profit loss, most loans done by these large institutions are losing $148 a loan. Now, that's no way you can sustain a business. Anyway, we'll get more into this as the show goes on. I'm Jeff Barton. I'm your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. 888-713-2929. That's the telephone number. Pick up the phone and give us a call. Yes, we talk mortgages, and we talk all things mortgages, all things related to real estate. Real estate is an all-encompassing thing, and we do shows here each and every week that are broadcast on a couple of our great affiliates, KMET, KCAA, as well as K-Tahoe. And I really appreciate those terrific outlets who bring message of what we do to, people like you driving around trying to figure out the mortgage market as well as real estate and everything else. One of the components of anything to do with real estate is, of course, the energy it takes to be able to run the house, run the air conditioning. I know in certain sectors of San Bernardino, Riverside, and also out in Las Vegas where the show is also being seen, energy bills can be astronomical. So we brought Zach Harmon, he's an energy broker out in Nevada, to come on the show once again, talk to us a little bit about what this is and how we can figure out energy costs and what's happening in the market. Zach, how are you?
I'm doing well, Jeff. Thanks for having me on the show.
Hey, thanks very much, and thanks for coming on. I know Zach's been on the television show, the Las Vegas Real Estate Show, and we've been trying to hook up because there's so many things going on in the regulation or deregulation in that particular market. Hey, can you give us just a brief outline of a couple of the bills that you were talking about and one of the propositions out in Las Vegas? I think we can all feel for deregulation desire on the part of the consumer, especially in the energy area.
Yeah, no, I mean, so question 3 on the ballot to deregulate the energy monopoly that NV Energy has had for, I would assume, many, many years. I probably over 10 years, although I haven't even lived in Nevada for that long. But I mean, there's two sides to it. What a lot of people ask me, being in the energy industry, should I vote yes on this? Is this a good thing for the future? Should I vote no on this? A lot of people don't understand. They're seeing YouTube advertisements with people saying, this is gonna, if you vote yes, it's going to bring rates down. As simple as that. And I've seen YouTube advertisements very recently about that. And when people ask me this, what I tell them to do is look historically as to what it's done. One, I mean, and then two, it definitely sounds like a great thing. I think that from a business perspective, having other companies come in and take a shot at supplying energy and to again break up that monopoly so that you actually have a choice in your energy sounds like a great thing. From a competitive standpoint, it sounds like a great thing. The whole thing makes sense. As far as bringing costs down, when people are going to compete, they're going to compete for your business. So costs should go down. That's what people have been thinking, and that's what people have been led to believe. And then the other side of it, though, is when I tell people to look at it historically, I mean, they did the same thing in a few other states recently, which was California. They did it in Texas. They did it in Connecticut. We also did it in my home state of Vermont. And historically, rates actually went up. So that's sort of the mystery behind it all. Again, I take the position that, you know, if you want to keep rates low, because actually in Nevada we have some of the lowest rates in the country per kilowatt hour. You know, you're looking at about 12 cents, just under 12 cents a kilowatt hour.
Is that metered to use? I mean, if you use more, do you pay more? How does that work?
So you actually have a choice. There's a general rate where you will pay the exact same no matter how much you use, unlike California, where there are tiered systems where they start you out on an allowance of about 20 cents a kilowatt hour, and then once you use it 4 times more than your allowance or 3 times more, then you're going to go into the next tier. And then they have a third tier for supercharge, the surcharge for super users. That's what it is. And it's at 40 cents a kilowatt hour, which is tremendous.
Right.
You know, I mean, compare that to a little 12 cents a kilowatt hour. I mean,
no, that's right. Right.
And you get the sense from Nevadans too. They say, you know, we do have high electric bills, but it's not because of the energy rate, but it's just because we use so much energy, because we use so much AC and different appliances like that.
Now, you've been in solar for a long, long time as well, right? I mean, that's kind of where you cut your teeth in a lot of the energy business that we talked about originally.
Yeah, well, it seems like a long time since you, when I put in the day-to-day basis, it definitely seems like a long time, but just a little over 2 years.
Oh, okay. Very well. It just for my, and there's been a lot of changes. I mean, from my standpoint, it just seems like it's been a long time. Maybe it hasn't been that long at all. Maybe it was like yesterday, but it seems like a long time. This is what happens when you get old, Zach. So, in the solar sector, in what you do and what you know about that, Nevada is one of the leaders in terms of solar usage and the percentage of electricity generated from solar usage. Is that right?
Yeah, well, the sun hours here, they beat, to my knowledge, any other state. I think the only other state that would come close to it is Arizona, kind of in that deep southwest area. That's where you really get the most sun hours. So there are a lot of large-scale utility projects of solar, and there's actually going to be a lot more, too. You know, in recent commercial solar news, they just there's an entity or a business that just signed the lowest cost power purchase agreement in the history of solar, which is they've signed a PPA, power purchase agreement, to buy power for 20 years. The term usually goes around 20, it could be 25, and the price that they're going to pay for it is at 2.5 cents a kilowatt hour, just below 3 cents a kilowatt hour.
Wow.
Yeah, so tremendous.
That's tremendous. Okay, so Zach, tell my listeners what it is that you do for consumers and businesses to help them figure out their energy costs.
Yeah, so within the solar industry, I actually act as a broker, which means that we have, on a residential and commercial scale, we have partnerships with 5 to 7 different installation contractors within any state or any market. And we give those top-rated installers that we have put through a vetting process before we partner with them. We give them the opportunity to go ahead and bid on our clients' projects. You know, the whole philosophy there being that when solar companies compete, then my clients win. So as a broker, I really represent the property owner, the homeowner, the business owner who's looking to cut their costs down. I represent them as opposed to any one particular solar contractor.
Now, give us an idea of energy savings when you get solar, and then obviously your particular expertise in negotiating for them, how you get the good or the good or the best deal.
Yeah, totally. So in Nevada, where the rates are, let's start with Nevada, where the rates are pretty low. The savings, the upfront savings that you get when you qualify for a solar installation, whether that's a finance or a lease, usually it's around 650 credit score. The upfront savings, and again, there's no cost on the installation if you pass the credit score.
Right.
You finance it through a similar model, just like you would finance any sort of costly appliance like a water heater or a gas heater for your pool or something above $5,000, and
Right.
in that range. So the savings that you'll see let's start with a finance, which actually when you finance it and you take direct ownership, you see the most savings than if you were to lease it.
Yeah. No, I don't recommend leasing just because it's a hassle if you sell your house and then you got to get the person financed who's buying your house, so it can be problematic.
Yeah, no, you'll hear a lot of realtors complain about that.
Right. I agree.
And when I hear that, I try to give them the advice of it is a little bit more work to sell a home with a lease, because now you have to match the pre-existing family's energy usage with the new homeowner. So if you have a home that you're selling and that home had a family of 5 people and their bill was $200 a month, they had a solar lease set up for that energy usage.
Right.
So you have to put a little bit more time into finding a new buyer to match that. You're not going to want to sell that to a person with just 1 or 2 people who are only going to use a bill of $100 a month.
Right, they'll be spending more than they actually would if they had a different energy output.
Right, and it just wouldn't be a good match. But back to the original conversation. So the savings that you would see from a finance standpoint, because again, financing it, you do see better savings. It's easier to sell the home. The property value actually does increase.
Yep.
There's a New York Times article, Consumer Reports talks about it, that you can expect to see a $15,000 increase in the property value. Now, I've talked to people who've had their home appraised for $40,000 more, $20,000 more, but a good expectation is at least $15,000, which is great for the property value increase for ownership of solar.
And just quickly, we have about a minute and a half left. So what happens is you get solar, you sell it back to the company, any excess, and whatever that particular number is, that's what you're saying is going to increase the value of your home because of the fact that you're not only saving money, you're making money.
Exactly. I mean, anybody who doesn't have solar, they're renting their energy from the utility company. So when you look at it that way, you're going to be spending money on electricity either way. So it just makes sense to spend it towards ownership. The same reason that you would buy a home instead of leasing one.
Hey, Zach, shout out your telephone number for our radio listeners who need some advocate to be able to kind of figure out solar, figure out how they can best use it, and obviously, get in touch with a great guy.
Yeah, totally. No, I mean, especially if you're in a California area, for businesses, they're seeing an ROI of 3 years.
Wow.
So again, because the rates are so high in California, so that you could do some really incremental damage in California. But my number is 802-371-9745. Again, that's 802-371-9745.
Zach, thank you very much for coming on the show. It's always great to talk to you, and we'll have you back again soon.
Thanks, Jeff.
Thank you very much.
Talk to you soon.
Yeah, exactly. That's Zach Harmon. He's an energy broker out of the state of Nevada, can help anybody, especially people out here in high-paying energy state California. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For questions or comments, send emails to info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. 888-713-2929. That's the telephone number. Pick it up. Give us a call. Talk mortgages. I know you got a problem. Why? Because nobody can afford a house today. Well, that's not necessarily true, but that's what you hear as a loan officer, a company owner, somebody who's been in the business for many years. Everybody's complaining that the programs are too stiff. They can't find enough money for the down payment. They're just having such difficulty with their credit score. Well, there are solutions out there, and one of the guys that has solutions and has had for many years is a terrific loan officer for Malibu Funding, Brent Gong, and he's joining us here today. Give us some solutions. Brent, how are you?
Good. How are you doing, Jeff?
I'm just fine. Thank you very much. Okay, give us a little synopsis of what's happening in the marketplace in the summer of 2018.
Well, we all know that housing prices have risen a lot.
Yep.
And we all, as we've anticipated, rates have been creeping up a bit. But as far as people thinking that they're not going to qualify for loans, the good thing is there's a lot more options available now, and they're not the extraordinary options that were available before the crash in 2007. But there's a lot of new non-QM loan programs with rates that are not very far off from conventional or government financing.
Give us an example of that, and everybody in my audience knows what QM is, so they're very educated and know everything about that. Give us an idea of what a program might be and the rate you might be able to get.
Well, for example, the self-employed people are the ones who know that they have the hardest time, qualifying because of the income that they show on their taxes. But there's programs out there where they can use 12-month bank statements. Even they get an even better rate if they can provide 24-month bank statements.
And that's their business bank statements, or is that their personal?
It could be either or.
Okay.
It's better for business, but they can even have multiple bank statements.
I see.
If they have 3 accounts, they can combine all of them. So it depends on the lender. But for example, on a jumbo-sized loan, $850,000 loan amount right now, somebody with a credit score of 709 is going to receive a 7/1 ARM at a rate of 5.5%, which is pretty competitive. That's actually only maybe a point off from portfolio jumbo financing, the traditional jumbo financing, which is extremely difficult to qualify for. But this borrower is able to get the money they need to do what they have to do, and that's actually by today's standards, that's actually a very competitive rate.
No, I think it is a competitive rate, and the one thing you mentioned was the 7/1 ARM. I think I started off the show by talking about the ARM product, and a lot of people remember back in the 2007, 8, 9 that ARMs were the anathema of the industry. It's a little bit different type of situation now, and I happen to like the ARM programs. Explain a little bit of the benefit of using an ARM.
Well, as the rates get higher, it is a way to get a lower rate. But the difference between now and the 2007, 2006 is there's no more. You don't see any more negative amortization on forward mortgages. There's not going to be anything where your principal is increasing or interest is being added. In a reverse mortgage, that would be the case, but we're talking about forward mortgages here.
Right, of course.
So there's no more negative amortization, no more options. It's still a fully amortized loan, and there's still caps on the trades. But even if you are getting into an ARM, a 7-year ARM is 7 years is a long time. But if you're
right.
getting into an ARM, whether it's a 3-year, 5-year, 7-year fixed period, the borrower definitely has to keep in mind, though, an exit strategy, or depending on what their situation is. If they plan on, they know that they're going to be showing more income, and they're going to eventually refinance again into a conventional or a portfolio 30-year fixed portfolio program, or if they just plan on selling and within a certain time, then it's the right option. But yeah, anytime somebody's taking it on, they should be wary of they should have their exit strategy in mind, knowing that the rates are going to adjust. But then again, there's also people who have had ARMs for years and are in the adjustment period, and
the rates haven't moved at all because the adjustables are lower than actually the fixed rates.
Exactly. Yeah. Some people think, well, my payment's going to triple at the end of the 7 years. That's not necessarily the case. It all depends on the index and where the index goes. And yeah, like you said, Jeff, there's plenty of people who just keep paying on their ARM because the payment, the index doesn't does not become extraordinary and doesn't price out their payment.
Now, give us an idea of the customers that you're dealing with. All kinds, certain types. Are they purchase people? Are they refi people trying to, as you said, take money out in order to do something with it? What are the customers?
Well, a lot of them are purchase. A lot of them are mostly refinance. But
okay.
Everybody I'm dealing with right now is some type of investor or somebody doing something. Taking advantage of the current situation in Los Angeles. So, as you know, there's a housing shortage
Yes, there is.
in LA.
Yep, everywhere.
Exactly, and rents are skyrocketing, home values are skyrocketing.
Yep.
So what the city is doing now is they're pretty much handing away, they're approving ADUs, accessory dwelling units, accessory dwelling units.
Yep.
Like they never have before. So you're able to convert your garage into an in-law unit without having to build a carport, and pretty much if you go to the city of LA, maybe 2 years ago they would have told you no. They would have made it real difficult. Now they're pretty much rubber stamping, plans and permits. So in the city of LA, a lot of people, a lot of homeowners. I'm not talking about developers. I'm not talking about property investors. Just every homeowners are saying, "Hey, I can get $1,700 or $1,500 for my garage. Hey, I don't need that garage. Let me take $60,000 out against my house.
Yep.
That's gonna, my payment might go up $300 or $400 from that. I'm even going to get a little bit higher of an interest rate because I might have a rate from 2016, and the rates might be about 3/4 to 1 point higher. But you know what? I'm going to spend $300 more a month and collect $1,500 a month."
No, I think that's a great formula, especially in the city. Now, a lot of these cities around the country are adopting very similar standards to Los Angeles in order to try to solve the housing crisis, because I don't see a big wave of new product coming on the market anytime soon.
Well, there's no land here.
Right.
Absolutely not. Yeah, there's no, unless people are going to move out to the outskirts, which I guess a lot of people are, but there's just nowhere to build. So a lot of people are. I have several customers right now who are doing this, and it's amazing how many are taking advantage of this. But it makes total sense when you look at the rental income that they're going to receive. So, yes, these people might even have a 3.75% on a 30-year fix that they took out in 2015, 2014, and now they're refinancing it. At 4.75% on a conventional loan, maxing out the amount of cash they can get out to take advantage of building another unit in the back, converting their garage.
No, I think it's a great idea. I've always said that the answer to the housing crisis isn't necessarily in building thousands and thousands of large or new homes. It's really allowing homeowners to take advantage of their own properties and building another unit. And it's right there, and they're going to be watching over it. It makes more sense than to try to trust somebody else to pay the mortgage when these people are already paying the mortgage. They're just going to use the rent in order to either, maximize what they can do to live or pay down the mortgage.
Absolutely, and on top of, not only in terms of the rental income is great. Them able to get their mortgage paid by the rental income.
Right.
But not only that, by doing this, they're adding livable, permitted square footage to their home. So they're also significantly increasing the value of their property.
Right.
So you might have somebody. I have a customer who's doing this in Reseda, where the property may be probably worth about $650,000 for it's a 1,800 square foot property, but they're adding a 600 square foot accessory dwelling unit, so now it becomes a 2,400 square foot home.
Oh yeah, that's huge.
They're getting the value back of what they're spending. And
hey, Brent, shout out your phone number. We're up against the clock here, and I got to get going. But tell people how they can get in touch with you. This sounds like a terrific idea for a lot of people.
You can just call me on my cell phone, my direct line. It's area code 818-585-7442.
Great. Thanks very much for coming on the show, enlightening us about this terrific idea, and we'll talk to you soon.
You're welcome. Take care, Jeff.
Thank you very much. And I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For questions or comments, send emails to info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry, 888-713-2929. That's the telephone number. Pick up the phone, give us a call. We talk all things mortgages, real estate, anything to do with both of those things. In the last segment, we talked to Brent Gong. He was talking about expansion in Los Angeles, and I know there are a lot of other cities who are doing this, even counties, even the state of California has thought about passing legislation for it, allowing homeowners to build another unit in order to try to solve some of the housing crisis we have. It has caused prices to rise rapidly, and it has caused people who want to buy a home to be priced out of the market in a lot of ways, because not only combined with rising real estate prices, you have rising interest rates on loans. Here with us today, once again, Kim Soash from Homebridge Mortgage. Homebridge Mortgage is going to try to help us figure out what is a way that we can try to help these people get into a home, especially if we've got both of those things happening at the same time. First off, Kim, how are you?
I'm great, Jeff. Thanks for having me on today.
And thank you for coming on. I really appreciate your expertise. You've been in the business for a good amount of time, and you're a very strong competitor in the triathlon world, which I really appreciate too, as you well know. And so,
I got one coming up.
Yeah. Oh, excellent. What are you doing?
Oh, Hanson Dam.
That's right.
Doing an Olympic.
Oh, man. I did that one time, and I faded at the end on the run, and I don't even think I completed the darn thing. And this was a half Ironman. Yeah, I was up in the dam, and it was just one of those things. But tell us, what is a good program that Homebridge is offering to these mortgage-starved people who can't seem to either afford it or get into it because they don't make enough money?
Well, we're trying to stay competitive. It's a highly competitive, industry. All the lenders, trying to, grab what business is out there.
Sure.
It's getting harder and harder for borrowers to qualify, harder for them to even, sometimes they qualify, can't find a home. Just the inventory isn't there. But we're offering some things that I think are, we're showing brokers and borrowers that we're trying to find a way. So in the government world, in the FHA and VA, we are taking credit scores as low as 550, which is often hard to place a borrower with when their credit scores are very low. We also, jumbo has all of a sudden become a competitive area where it was often hard to place jumbo borrowers that didn't have a score of at least 700, and now we can do credit scores down, 620.
Now,
so
is that, Kim?
Different options for these lower credit scores is really huge, because that's been a real, like a barrier for a lot of borrowers.
Yes, it is, and I apologize for that, but it piqued my interest immediately, because I'm thinking, okay, so obviously your investors, the people that are buying your loans, are saying, we will now buy these loans, or are these portfolio-type products where you're keeping them in-house?
No, these are investors that are saying, we've increased our appetite for these types of borrowers. So we're gonna buy these loans. We're gonna accept. A jumbo borrower with a 620 credit score can get 80% financing up to $1.5 million. So that was unheard of before.
Wow, that's amazing. That's pretty good, actually.
660 credit, 85% with 660 credit. Actually, I take that back. 90% financing with 660 credit to $1 million, but 85 to $1.5 million. So these were just unheard of before. It seemed like jumbo didn't want to be competitive, and it would only be competitive if you had really perfect credit, really perfect borrowers.
Hey, I want to ask you a question. There are a number of large banks who do mortgages who are laying off some in their mortgage division. And obviously it's because there aren't enough loans to satisfy the need for companies to be able to afford certain types of staffing. So how is Homebridge hanging in there? What are you guys doing in terms of obviously all these programs are offering more so that you can get more loans? What's your thought on that?
Well, I think that Homebridge, one of the attractions to me for even coming to work at Homebridge, which I've been here, almost 5 years now, but my initial attraction was just the diversity, and I think that was my thought going in 5 years ago, and I think that's paid out, to me, in being able to keep getting business and getting, having people look to you as a source for having a place for their borrower, whether it's because they had a low score, maybe they have a high score. We're trying to balance all these things, have a diversity of product offering, but still be competitive in the regular offering. So I'm time and time again told that, other just common areas of high balance or FHA, that our pricing is competitive. So in the regular vanilla categories, we're staying competitive and still offering these things that are maybe hard to place. So whether it's we've got someone with a low credit score, I think I don't want to misspeak, but I don't know of anyone who has a bigger variety of rehab loans. And we have rehab loans. We're not doing construction, but we do rehab. So you can buy the ugliest house on the block in the neighborhood or the school that you wanted and build in those renovation costs. And it's like, well, I like that house. This is the school, but I really needed 2 bathrooms and it only has 1, or I needed 3 bedrooms, it only has 2. You can build into your loan amount the rehab that will make it be the house, of your dreams.
And what kind of program, what is that called?
Well, people are probably most familiar with a program called 203K, which FHA offers, and that's owner has to be owner-occupied only. But we also have this other program called Homestyle Renovation.
Oh, yeah.
And that's a Fannie product. So it's really Fannie Mae lending with a construction rider, and it'll allow owner-occupied, second home, investment. You're really just, like I said, getting a regular Fannie Mae loan. Your appraisal value is going to be based on the property's future value. So, I'm buying it for $400, but after I'm done fixing it up, it's going to be worth $600. So if it's 95% loan to value, it's based on that $600 amount, not what you're purchasing it for. So that's where you get, your financing to, make it be, like I said, make it be the house you want, have more bedrooms. Maybe you wanted a pool, so maybe it's to put a pool in, or, you'd really rather have, maybe you were thinking of moving, and then when you look around at what's available, it's like, I haven't seen anything I like better than my house, but I want to do some things to my house. So you could do this as a refinance and, put a pool in, or build an outdoor kitchen, or update your kitchen, or, do something.
What are the rates like? Are they just basically a typical FHA loan, or is it based on something else?
Well, it's its own product, so it's actually, it's called Fannie Mae Homestyle Renovation. So the rates, I would say, ballpark, this isn't exactly the amount, but the rates are basically probably about a half to a point higher in rate than it would be if you weren't baking a construction loan, into your mortgage. And we don't have a time frame for them to get out of it. So you can, once your construction is done, you can refinance into a regular loan. It's a regular 30-year fixed loan. So it's not that the rate's so horrible you wouldn't want to just keep it. But, you could refi out of it once your construction's done if you wanted to. And
how difficult is it documentation-wise? I mean, obviously, it sounds like you've got to get a futurized appraisal, which is in itself an issue that I can foresee. But in terms of does the bank come out with a contractor and check your figures versus what they consider to be the renovation costs? Is that how it works?
I would say that... if you have this sort of scenario that you want to do for certain, call me, reach out. I would tell a realtor or a loan officer to not oversell this product as being something you could do in 30 days. You could definitely do it in 45 or 60. And the reason being that you have some moving parts that aren't part of a normal loan, which is contractors.
Right,
so you have to have contractor bids with line item descriptions of the work that's being done, the scope of work that's being done, how much the costs are, what materials are being used. And then depending on, both of these have a kind of a threshold that if it's under $35,000 in renovation or over. And so if it's over $35,000, we would want like a HUD consultant to come in, and he kind of keeps the contractor, it kind of makes sure that the work that's being quoted is likely accurate, so
of course.
He could come in and he can say, I think your contractor is underquoting this job because I think they couldn't get all these things done for this amount, or he would say, hey, your contractor is missing this, or this. It might be a zoning or compliance issue that needs to be included. So the HUD consultant is
pretty good,
actually like a neutral third party that kind of makes sure everything is good.
No, I think if you've got someone in there really watching the deal, making sure that things are correct, that's probably a very good thing, not only to protect the homeowner, but obviously protect the bank and the lender.
Well, and the other nice thing is that Homebridge offers a in-house concierge that that manages the loan, because basically you kind of have this big escrow holdback, where they're going to,
Sure.
we have this excess of money, and then it's going to be paid out in draws, as the work's getting completed.
Sure.
And our in-house concierge manages that. So after the realtors get paid and the agents are paid and the loan officers are paid and everybody goes on their merry way, we have a homeowner who's got a 6-month construction project maybe going on,
right.
and Homebridge hasn't abandoned them. We have someone who's making sure the job stays on time, makes sure that people get paid,
right.
and makes sure that the borrower has someone to be in contact with regard to this this project. So we don't want them to feel like everybody left them with a contractor.
Absolutely. We have about 30 seconds left. Could you shout out your phone number, because this is a very interesting idea for people out there who are listening. How do they get in touch with you?
Absolutely. Call me at 818-970-4016, or email me, K Soash. My last name is S as in Sam, O-A-S as in Sam, H. So ksoash at homebridge.com, and I would be happy to talk more about this with anyone.
Thanks very much, Kim. That's great advice, and I really appreciate you once again coming on the show.
Thanks, Jeff. It was great to talk to you. Have a great day.
Thank you, and you too. And I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For questions or comments, send emails to info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. 888-713-2929 is the telephone number. Pick up the phone, give us a call. We do have an email address, info@malibufunding.net, as well as a YouTube account. If you go to YouTube, look up my name, Jeff Barton, R.E. Mortgage, and you will find that you'll see about 70, 80 shows on there, and they're basically this particular show that we shoot for the radio stations, as well as the mortgagevoice.com, as well as the Las Vegas Real Estate Show, and I think we're 30, 40 shows deep into that as well. And Daryl, how many shows we've done here? A couple hundred?
This will be 123.
123. That's at least a couple of years here at this particular studio. We've probably done about 40 or 50. I like this studio. Do you like this studio? This is very comfy for me.
They call it the wine cellar. The last place was Stately Wayne Manor. This is the wine cellar.
Yes, no, I like
and
it.
There's no wine.
No, of course.
Which is okay for me.
I could complain. That's kind of like a wine.
We'll get the maitre d'. Hold on. Garçon.
Anyway, I'm Jeff Barton. If you've got ideas and things about the show that you'd like to see or like some comments, we do get comments on the email as well as on the website. Malibu Funding, who is the sponsor of the show, they have a website. It's www.malibufunding.net. And on that site, you can see 40, 50 different loan officers, as well as the products and things that they do in order to try to help you get into a home. Malibu Funding, yes, they are in many different states, 10 different states, East Coast, West Coast, South Coast, and of course the wonderful state of Canada. Yes, that's right. That's the 52nd state Canada is, and we have a terrific loan office up in the state of Illinois, which butts up against it. So if you're in a lot of these different places and you need a loan, go to Malibu Funding. Malibu Funding can help you in any number of different ways. Let us serve you better. I wanted to talk about, there was a report that came out and talked about what happened, what we learned in the fiscal policy from the Great Recession or the mortgage meltdown or the happening of 2008, 2007, and what we learned about that based on the happening of the mortgage industry and how that affects fiscal policy right now. What is fiscal policy? Daryl, give us an idea of what you think fiscal policy is. Not that I know any better than anyone else, but I have the answers in front of me, see, so I can actually come up with them.
Well, fiscal policy is supposedly hitting a state of equilibrium between inflation and, making things affordable.
Yes, exactly right. So if you have a fiscal policy as a government, let's say you're in a bad way, and like it was in 2008 when we had the crash, and all the way through 2009, almost to 2010 before the economy started growing again, we had unemployment rates in some cities 25%, and certainly the national rate was up around 11, 12%. How does government, how do people who control things, how do they stimulate the economy in order to get people back to work, in order to try to turn things around? And one of the things in this report was it runs counter-cyclical to what you might think. For instance, in bad times, government has to print more money in order to stimulate business, in order to keep people working. That's what the Keynesian economic theory had, and why the Great Depression was so long and so deep was because the government did not do that, and that's a philosophy. There are many philosophies out there, but in this particular article, let's talk about just that particular policy. On the flip side of that, of course, is during good times, what happens is fiscal policy tends to rein in government spending, rein in the ability to print more money, let the private sector do most of the work. So in this particular article, it talked about things that would run counterintuitive to that. And one of the reasons, and I often think that this is the case, for instance, when Freddie Mac and Fannie Mae, the two big purchasers of mortgages in the United States, when they went almost belly up, and there were screams, and still are screams, to reform the entire mortgage system, get the government out of the mortgage business. Liquidity aside, maybe the private sector could do it better. Certainly rates would rise tremendously, and you would probably see a freezing of the housing market because nobody could afford to buy anything. However, when that happened in 2008, and I think it was $160 to $170 billion, and they traded the money that they just printed from the Treasury, and they took over conservatorship, or really ownership, based on that particular loan from the government. What happened when it turned around 10 years later, and these particular entities are making, $4 to $8 to $10 billion a quarter, and the government didn't want to give up their share of what those entities were now worth. The original deal was, all right, we'll bail you out, you'll pay us back, and then you'll basically be on your own, or you buy it back. Well, not only does the government not want to do that, it has become a revenue stream for people in Treasury, and there's a great deal of concern that not only that has happened, but the government cheap money, which thankfully it is ending, albeit incredibly slowly, and maybe that's a good thing, but we've got a 3% or so GDP rise each year, and we'll probably see a little bit more during the Trump years, just because of the tax overhaul, or the tax cut for the wealthy and for businesses. We're probably going to see a GDP growth rate this year, 2.8 to 3.2%, in that range. From what I've read in a number of economists, you get real optimistic, or you get, now this is all based on, a $15 trillion economy. So this is a big number, this 3%. And if it goes up 0.1% or down 0.1%, it's still a huge number. And so what happens when cheap money is available, it's very difficult to shut that cheap money off. Now, as I said, Bernanke and Yellen and now Powell have all gone to this very slow rein-in of the Fed cheap money, but it's still relatively cheap out there, and a lot of businesses do not want to see that. So when we talk about money and stop spending money, I think what we have in this particular president and this particular Congress is a lack of desire to rein in on public spending. So what we've got is a rise in the debt, a rise in the long-term debt of the country, and I don't think that's necessarily a bad thing, but it's certainly not a great thing. We have really not looked at fiscal conservative hawks the way we did when the last administration was in office. Now, why do I bring this up? Because it affects your ability to get a mortgage. It affects your ability, obviously, to buy a house. If we've got a tight money supply, i.e. we haven't had a tight money supply, money's been plentiful, rates have been really low, and so people who not necessarily can afford a house at 5% could at 3.5%. I mean, that's just makes sense, right? The payment on a $100,000 to $500,000 house is going to be the difference between $1,500 and $4,500 extra in payments a month, just based on a 1.5 increase. So as you can see, yes, cheap money or fiscal policy really affects you on Main Street. And what we've got is a push-pull between really conservative fiscal policy, which I happen to applaud in good times, versus in bad times during the Keynesian viewpoint, which is no, flood the market with money to make sure that there's plenty enough out there for investment and everything else to make sure that people continue to work, people get a paycheck, and unemployment benefits get extended, all those kind of things. But now that we're in the reverse of that, whether it's with Fannie and Freddie, hey, they should have that conservatorship ended. The government doesn't want to do that. That's not good for private sector getting back into the mortgage business. Or in the reverse of that, obviously, when you're talking about actual money being printed versus being constrained at the Fed or at Treasury, and you're having interest rates climb probably a point to a 1.5 this year, probably a point to a 1.5 next year, so that by the time 2020 rolls around, you're probably going to see rates back up at 6.5 to 7%, which is where they were, pre-recession. Anyway, I'm Jeff Barton. These are all good things to think about when we're thinking about mortgages, when we're thinking about how to get money and how it all works. Just understand that the federal government's fiscal policy has nothing to do with your fiscal policy. If you can't pay your bills, you're not printing money. So, word to the wise, keep your credit score high and keep paying your bills on time. I'm Jeff Barton, your voice in the mortgage industry. Thanks for tuning in. We'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.